Traditional startup funding is dead. Is the traditional startup playbook of trying to chase venture capital money and selling your personal and corporate soul to your VC partner dead? For decades, there was one startup dream. It was all about the hustle, the sleepless nights, and those massive offices with ping pong tables. All of it served a single goal: hitting that billion-dollar valuation, becoming a unicorn. But let's be honest, that dream has become a statistical nightmare. You've seen it. A company gets a huge funding announcement, a splashy article, and then, poof, they vanish. The hard truth is that for most founders, the path to $1 billion is a path straight into a brick wall. A staggering 90% of startups fail. Let's say that again. A staggering 90% of startups fail. But what if the real dream looks a little different? What if the new playbook isn't about raising millions from VCs, but about building a business of one that makes millions? Today, we're going to show you exactly why the unicorn dream is dying and what you, the next generation of builders, should be creating instead. Introduction. The story of the modern startup has been dominated by a single narrative: raise venture capital, scale at all costs, and chase that mythical unicorn status. It's a great story for a movie, but the numbers tell a much different one. According to research from Harvard University, a whopping 75% of venture-backed startups fail to return cash to their investors, and around 30–40% of those end up liquidating everything. This isn't a sustainable model, it's a lottery ticket, and the odds are heavily stacked against you. So, the big question is, why is this happening? Why is the playbook that created Silicon Valley legends now leading so many founders right off a cliff? And more importantly, what's quietly taking its place? First, we'll deconstruct the 3 core reasons the traditional startup model is a crumbling pillar. Then, we'll explore the new foundation being laid by a different kind of founder, one who's focused on profitability, freedom, and control. Section 1. The crumbling pillar. Why the unicorn dream is dead. To see where we're headed, we have to understand what went wrong. The venture-backed model isn't just risky. For most businesses, it's fundamentally broken, and it boils down to 3 fatal flaws. So let us take a brief pause here. If you're finding this useful, do me a favor. Hit that like button and drop a comment below. Hit me up with questions of comments with your thoughts. I would love to get both your comments and thoughts. I will read every single one of them, and honestly, this will help me figure out what we need to cover next. And if you haven't subscribed yet, go ahead and do that too, because we're going to be unpacking a lot more of these practical risk topics. If you're finding this useful, do me a favor. Hit that like button and drop a comment below. WRE, going to be unpacking a lot more of these practical risk topics. First, and most importantly, is the venture capital trap. Getting a check from a big-name VC feels like you've won the game. But for many, it's the beginning of the end. Think about it. Less than 1% of all startups ever get VC funding in the first place. But here's the kicker. Even for that tiny, elite group, up to 75% still fail. Why? Because VC money isn't just a resource. It completely changes your company's DNA. The second you cash that check, your goal is no longer just to build a great, profitable business. Your new goal is to generate a 10x, 50x, or even 100x return for your investors. This creates a twisted reality where a perfectly healthy, multi-million-dollar business can be labeled a failure by a VC if it doesn't have unicorn potential. The investor's need for a massive exit starts to dictate every decision. You lose control. Suddenly, conversations that should be about your product and customers become political debates about what looks best for the next funding round. This deep misalignment is a primary reason so many promising companies die on the vine. The second fatal flaw? The pressure cooker of hypergrowth. Venture capital is rocket fuel. It's designed for one thing: speed. But what happens when you strap a rocket to a car you haven't finished building? It completely falls apart. This is the story of premature scaling, a phenomenon that kills 74% of high-growth startups. VCs will often push you to hire aggressively, and expand into new markets before you've even figured out if you have a product people actually want. This leads directly to the number one reason startups fail. They build something nobody is willing to pay for. A shocking 42% of failed startups made that exact mistake. They got so caught up in fundraising and hiring that they forgot to actually talk to their customers. The relentless pressure for that hockey stick growth curve forces founders to burn through cash at a terrifying rate, hiring people they don't need and destroying the very culture that made them special. This isn't growth. It's a bonfire of cash that ends the moment the money runs out, the second biggest reason for startup failure. If you're finding this useful, do me a favor. Hit that like button and drop a comment below. Tell me, what do you think about raising capital in today's world? I would love to get your thoughts. I will read every single one of them. And honestly, your horror or success stories help me figure out what we need to cover next. And if you haven't subscribed yet, go ahead and do that too, because we're going to be unpacking a lot more of these practical risk topics. And that brings us to the third reason the old model is obsolete. The market has fundamentally changed. The old playbook of raising millions to hire huge engineering and marketing teams is a relic. Today, the tools available have radically leveled the playing field. The rise of artificial intelligence, in particular, is a total game changer. AI tools can now automate everything from customer service and content creation to bookkeeping and data analysis. One person, a solopreneur, can now leverage AI to do what used to take a team of 10. On top of that, the funding environment itself has shifted. Investors aren't just throwing money at hype anymore. They've become far more selective, prioritizing startups with real revenue and clear signs of execution over speculative paper unicorns. In this new world, large bloated teams are no longer an advantage. They're a liability. The market now rewards businesses that are lean, agile, and profitable, the exact opposite of what the traditional VC model demands. The world changed, but the old playbook didn't. Section 2. The new foundation. What's being built instead? So, if the old way is broken, what's taking its place? It's a powerful mindset shift toward new models that prioritize sanity, control, and actual profit. For most founders, these aren't just alternatives. They are flat-out better paths. Let's look at the three most powerful new models. First up is the bootstrapper's revolution. Bootstrapping is the art of building a company with nothing but your own savings and the revenue it generates. Instead of chasing investors, you chase customers. Companies like MailChimp, Basecamp, and Zoho are legendary examples. MailChimp was bootstrapped for 2 decades before being acquired by Intuit for a staggering $12 billion. Zoho, a global SaaS giant with over 100 million users, has never taken a dime of VC money and has been profitable from the very beginning. The power of bootstrapping is control. By focusing on profit from day one, founders are forced to build something people actually want and are willing to pay for. It solves the no market need problem by default. Every dollar is scrutinized, which builds incredible financial discipline and efficiency. This creates resilient, sustainable businesses that can ride out economic storms far better than their cash-burning VC-backed cousins. The second model is the rise of the solopreneur. If bootstrapping is a revolution, then solopreneurship is the insurgency. A solopreneur is a founder who builds a highly profitable business with 0 employees. This isn't just a freelancer. This is a business of one that can generate millions in revenue. People like Tony Din, who built a portfolio of products and hit a run rate of $45,000 a month in just 2 years, are perfect examples. How is that even possible? The answer is leverage through technology and audience. Today's solopreneurs use AI and no-code tools to automate tasks that once required entire departments. They build a personal brand and a loyal audience on platforms like X and LinkedIn, which becomes their distribution channel. They aren't just building a product, they are building a community. This model offers the ultimate freedom, the ability to run a massive business from anywhere in the world, completely on your own terms. Finally, we have the indie hacker ethos. The term indie hacker describes founders who build and launch online businesses independently. While it overlaps with solopreneurship, the indie hacker ethos is really about the love of building. These are makers and developers who focus on creating small, profitable products that solve a specific niche problem. Instead of betting everything on one massive, world-changing idea, an indie hacker might build a portfolio of small bets. One project could be a browser extension that makes $2,000 a month, while another is a niche SaaS tool that brings in $10,000 a month. This approach spreads out the risk and creates multiple independent streams of income. The community is incredibly transparent, with founders openly sharing revenue numbers, strategies, and even their failures. It's a collaborative ecosystem focused on learning and mutual support, a complete 180 from the secretive, high-stakes world of venture capital. The goal isn't a billion-dollar exit, it's to make a great living doing what you love. Conclusion, your path forward. So, the billion-dollar unicorn dream, the one built on endless funding and unsustainable growth, is on life support for the vast majority of founders. The frantic chase for venture capital is being replaced by a calmer, smarter pursuit of profitability and freedom. The crumbling pillar of hypergrowth is giving way to a new foundation built on sustainable, efficient, and founder-controlled businesses. And this isn't an end, it's a liberation. The tools for this new era are already in your hands. AI can give you the leverage of a 10-person team. The internet allows you to build a loyal audience right from your laptop, and the success of bootstrappers, solopreneurs, and indie hackers proves that you do not need an investor's permission to build a wildly successful company. We are entering a great selection cycle, where the businesses that win won't be the ones that raised the most money, but the ones that provide the most value with the greatest efficiency. The question is no longer, how do I build a unicorn? The real question is, how do I build a profitable, sustainable business that serves my life instead of the other way around? Call to action. If you're ready to ditch that old broken playbook and start building on this new foundation, your journey starts right now. The first step is learning how to find a real problem to solve and a customer who will happily pay for the solution. To help you do just that, go watch our last video. Find your next business through your daily struggles. If you're finding this useful, do me a favor. Hit that like button and drop a comment below. Tell me, what do you think about raising capital in today's world? I would love to get your thoughts. I will read every single one of them, and honestly, they help me figure out what we need to cover next. And if you haven't subscribed yet, go ahead and do that too, because we're going to be unpacking a lot more of these practical risk topics. Thanks for watching. Now go build something real.